In this week's video, we'll compare the facts supporting the case for a blow-off top relative to the facts supporting the case for much higher highs. The major topics for this week's video: CNBC article. We'll cover every single blow-off top case. Then we will shift gears and cover 10 hot off the presses new stock market signals. We'll talk a little bit about the expense ratio for the CCM current allocation and a limited time offer relative to investment minimums. On the right side of your screen is a CNBC article dated December 4th about blow-off tops. It contained this table compiled by Ned Davis Research. We reached out to Ned Davis Research and asked, is Ned Davis calling a blow-off top? They were incredibly helpful and friendly, and they forwarded this report. Notice the title of the report. The first three words are trend leans bullish, but two potential warnings. One of the warnings is a seasonal. The other one is the issue of a potential blow-off top. Under our approach, I think it's logical to think of a warning as a data-based reason to help us maintain that all-important maximum flexibility. It doesn't necessarily mean we're going to do anything with the data other than possibly pay attention a little bit more closely to the key data points going forward. Thus, from our perspective, how concerning are these dates here relative to the probability of 2019 experiencing a blow-off top? This text here and this chart here is from guppytraders.com. We included it because it does a nice job defining the basic concept of a blow-off top. I think if you take the time to compare these bullet points here to the chart of the Dow, you'll find the chart of the Dow in 2019 really can't check any of these blow-off top boxes. So let's quickly walk through the charts from the CNBC blow-off top article. We will move quickly because the data at the end will do the talking for us. If you're well-versed in technical analysis, I think it's fair to say we could classify 1929 to 1946 potentially as blow-off tops. But given this market hasn't made a new all-time high literally for well over a year, it's difficult to say 1948 meets the standard definition. Similar situation here. Probably checks enough boxes. It's really difficult to say this consolidation and move here is a parabolic blow-off top. These are three of the cases included in the CNBC article. From a traditional technical analysis perspective, these look like long-term periods of consolidation rather than parabolic blow-off tops. These four cases were covered in the CNBC article, and all four of them probably check enough boxes to be included. These two charts here look more like the pure definition of a blow-off top. However, it's very difficult to say this point here looks anything like a blow-off top. In the last two cases in the CNBC article, probably fair to keep this one, steep slope, and probably fair to keep 2011. So we're going to look at data from two perspectives, keeping all 18 of the historical cases, and then isolating the cases that seem to meet the definition of a blow-off top more clearly. But before we do that, let's look at the present-day case. This is the Dow Jones Industrial Average. This is the recent peak on November 27th, 2019 here, and this is looking back 670 calendar days to this peak here. It's very, very difficult to look at this sideways consolidation price action and say we really can check any of these boxes here. Do we really have a buying climax, a dramatic increase in price, a bubble? Are we really at the end of a prolonged uptrend? 670 calendar days is 1.83 years. If we look back at the 10-year average annual return for the Dow, over 1.83 years, we would expect to see, under normal circumstances, a gain of roughly 19.6%. If we had a dramatic increase in price, or a buying climax, or a bubble in price, we would expect the gain, looking back 670 calendar days, to basically blow this gain out of the water. Is that the case? No. Our actual gain, looking back 670 calendar days, is well below the 10-year average or expectation of 19.6%. If we look backwards, what we have is an extremely tepid gain of 5.81%. And the only way to look at this fairly is to compare apples to apples. Relative to our expectations for a blow-off top or a parabolic move. If we look at these cases from the CNBC article, how do the 670-day look-back gains compare to the present-day gain of 5.81%? If we look at all 18 of the historical cases, the median gain looking back 670 calendar days just blows this gain out of the water. It's 39.54%, which is 6.8 times more than what we've seen looking back 670 calendar days in the present day. It's very, very difficult to look at 5.81% and use the term parabolic, bubble, or dramatic. And that's not being critical of Ned Davis's warning. Ned Davis's warning is based on a rational and logical approach using data. And we do agree it is prudent to keep an open mind about the possibility of a blow-off top or a failed breakout. These cases here may not look like blow-off tops, but we all know failed breakouts can be disastrous. So our guess is Ned Davis is saying, hey, I've seen some data here that's similar enough for us to keep a flexible, unbiased, and open mind going forward. And if the data that we use to make decisions starts to deteriorate, then we're going to be much, much more open to making the necessary adjustments if that happens. We fully agree. How does this number here look if we throw out the cases that really don't meet the eyeball test for a blow-off top? So we want to focus on the cases that really do look more like a textbook blow-off top. Given we're looking for a bubble or a parabolic move or a dramatic increase in price, we would expect this number to go up. And that's exactly what happens. Now the median gain goes all the way to 50.38%. Does the present day really look like that? 50.38% is 8.7 times more dramatic or more parabolic than 5.81%. So to put the 50.38 and the 39.54 in perspective, it basically says in those cases, instead of drawing a line here with a tepid slope, we'd be drawing a line with a much steeper slope and a much steeper slope. A steeper slope speaks to moving away from a base rapidly. The higher these numbers are relative to a base, the higher our risk. We're basically just breaking out of a base now. And remember in last week's video, we talked about breaking out of a base is a good time to invest, not a risky time, because what once was resistance may now act as possible support. And these cases here from the Ned Davis research tell us if we fail in this direction, fail in this direction, or fail in this direction, or fail in this direction, we wholeheartedly agree we should respect that. So based on this analysis and these figures here, it's very, very difficult to say that the present day looks like a textbook blow-off top. You can find more information in this post dated November 18th. You can find it by Googling this title where my cursor is. And I'm going to guess that Ned Davis would handle this the same way we would going forward. How is that? If the core data remains bullish, he really does nothing with the warning. If the seasonal pattern doesn't develop and show up in the core data, you do nothing with it. The seasonal warning And the data-based warning in the present day helps us keep that flexible, unbiased, and open mind. If the core data flips from bullish to indecisive to bearish, it's going to be much, much easier to take action from a perspective of being aware of the warnings in advance. You can pause your video player to see some additional perspectives on the concept of a blow-off top relative to the present day. You can find a tweet about impeachment in our Twitter feed. Basically, nothing has changed relative to the original assessment because President Trump's approval ratings within the Republican Party have not changed in any material way. In this segment of the video, we'll be covering 10 new factual signals, things that just happened, things that we can see, measure, and put in a model. And we'll ask ourselves, do they contradict or align with the bullish hypothesis? All things being equal in the stock market, we would prefer to put our capital in harm's way when the odds are in our favor, and we would prefer to reduce our exposure or mitigate the damage when the odds are against us, which is basically the main objective of looking at data and using the CCM market model. It's important to note in these videos, we use a weight of the evidence approach, and we use examples to illustrate basic concepts. If you know your market history, you know these years are years where bad things eventually happened. And from a probability perspective, these are the type of looks that we want to avoid. This is the Dow peaking here in the year 2000. This is MACD monthly rolling over. We can see this, measure it, and put it in a model early in the bear market. We never get a bullish cross during this entire period. Very, very similar situation, 2007, 2008, relatively early in the bear market. We can see this, measure it, and put it in a model. In shorter term situations, sometimes a look like this is telling us that momentum is shifting quickly and risks are increasing. A lot of white space between black and red, and then the sharp rollover in here. Visual evidence here as well as here. Remember, we're using examples to illustrate basic concepts used in the model. These are all favorable periods or looks that we would like to embrace. And as you can see here, the turn after the 1987 crash in late 1988, early 1989 looks discernibly different from these looks that we want to avoid. If you've been watching these videos, you know 1995 is a very favorable period walking forward. Similar situation. If you started reallocating to risk here early in 2003, that would have worked out extremely well. Similar situation in 2009. If you used visual and observable hard evidence to start allocating back to risk, that worked out extremely well. And if you know your market history, you know we made a major low here in early February 2016. This is a longer term, more of a confirmation signal. And once again, this look here really doesn't look anything like these looks here. How is all of this useful? Well, we can compare these looks to the present day. And if we push aside our opinions, personal biases, our egos, our personal politics and emotions and ask, do the present day facts look like the avoid cases or the looks we want to embrace cases? Here's the look of the exact same chart, monthly chart for the Dow, and this is monthly MACD. It's pretty easy to see that the present day look looks a lot like every single one of these looks we want to embrace cases, and the present day look doesn't really look anything like the look that we want to avoid cases. And it's noteworthy. We just had this cross nailed down 6 calendar days ago on the last day of November. Does this look here align with or contradict the bullish thesis that was based on a hypothesis that was formed after a breath thrust that we could see, measure, and put in a model in early January of 2019? The answer is simple. It aligns with it. It does not contradict it. We covered this signal in detail in the November 27th video. Then we asked how many similar cases dating back to 1948 and what happened next in the stock market. These are the similar cases here. And this is the subsequent stock market performance walking forward, which is the equivalent, hypothetically, of walking forward from the end of November 2019. 100% of the cases positive 1 year later, 2 years later. 88% of them 3 years later, 88% 4 years later, 100% of the cases higher 5 years later. The red and the yellow help us keep a flexible, unbiased, and open mind and have realistic expectations about how markets operate in the real world. One of the key takeaways from recent signals is the probabilities tend to be very favorable looking out 1 to 2 years. Do we have anything else that supports this look here and aligns with this table here? Evidence. The answer is yes. Dow Jones European Financials Index, monthly MACD, bullish cross. We only have data going back to 2002. This look is forming in the month of December. Thus, this is an extremely fresh signal. We're trying to nail it down this month. If we don't get it in December, the odds say it will come relatively soon. But it's important to note it's not nailed down until the end of December. If it holds, historically, really good things have happened in the S&P 500. That's what these tables are showing. We're not invested in the Dow Jones European Financials Index. We're using this as a confirmation signal for this signal that we already have in hand for the S&P 500, NASDAQ, and Dow, and we've covered all of them in recent videos. Our model is a weight of the evidence approach. And this cross that's trying to form typically is followed by very satisfying performance in the S&P 500 index. Once again, does it align with or contradict our hypothesis? This is the Dow Jones European Financials Index. How about a broader Dow Jones World Financials Index? If banks are turning, that's typically good for the economy. Why? If banks are profitable, they're going to be much more apt to lend, which, all things being equal, tends to be good for economic growth. Present day look. Look in 2016. Look in 2012. Once again, using all the data available to us. What happened following a look like this and a look like this? The answer is really good things happened in the S&P 500 walking forward. Yellow, red tells us to have realistic expectations about day-to-day volatility, 100% normal and to be expected volatility. Look at these numbers here. 2 years out from the date of the signal, the average gain in the S&P 500 was just under 30%. That aligns very, very nicely with this slide that we covered last week, where we said, based on the facts that we have in hand, wouldn't be unreasonable for the S&P 500 to be 30% higher in 2 years. And this signal in the Dow Jones World Financials Index aligns with that hypothesis, simply telling us to keep an open mind about better than expected outcomes. The model, which literally answers hundreds of questions about the stock market, binary yes or no questions, governs our actions, and it contains inputs on multiple time frames, some of them much, much faster than a monthly MACD signal. In fact, most of them much faster than a monthly MACD signal. That's why we're calling these confirmation signals. Do they align with or contradict the allocation that we're already in based on things that have already happened? This type of study does not govern anything that we do. It helps us execute better. No different than Ned Davis's keep an open mind about a blow-off top study. He's not necessarily taking action based on that warning. It just helps him keep an open mind about a wide range of outcomes. Anything else? Yes, Dow Jones Japan Stock Index. Signal just happened, nailed down 6 days ago. After you can see this, measure it, and put it in a model historically, looking at all the data that we have, really, really good things tended to happen in the S&P 500 index, walking forward 1 month to 5 years. Dow Jones European Consumer Goods Index, bullish cross in the books. Typically, really good things happened in the S&P 500 walking forward from 1 month to 5 years. And notice, this cross happens here in 2012 above the center line. This cross, 2017, above the center line. The recent cross above the center line. All of that aligns with the secular trend thesis. This is a cyclical pullback within a secular trend. Not the case here and not the case here. This is the Consumer Goods Index. Anything else? Yes, if you know your market history, if the present day looks like 2017, 2012, 2009, or 2002, early 2003, that typically would be a good thing from a probability perspective. That's exactly what we have in early December in the Dow Jones European, excluding the United Kingdom, index. Historically, what has this meant for the S&P 500? And notice, we're using all of the data. Our monthly MACD starts right here. We can't use anything back here because we don't have the data. The answer is really good things tended to happen in the S&P 500 index. You can pause your video player at any time to look at the tables in more detail. Yellow says realistic expectations about 100% normal and to be expected volatility. You're only going back to 2002. Yes, but we're using it as a confirmation signal for a recent study that we did that goes back to 1948 and covered 71 years of data. This study is basically saying the same thing relative to all of the new studies that we're covering this week. They're confirmation after the fact signals. We already looked at the European Consumer Goods Index. How about if we go a little broader? The entire globe, the Dow Jones World Consumer Goods Index. That's a familiar look there, isn't it? This looks a lot like the look that we want to embrace and really doesn't look anything like the looks that we want to avoid. And notice in these long-term signals, is it possible that you get a whipsaw? Absolutely, positively, yes, but it doesn't happen very often. Why is that? Because a longer-term signal is less impacted by shorter-term news events. These type of crosses and trends are impacted by longer-term events and longer-term economic trends. We're not using any of this to forecast anything. If a whipsaw occurs on any one of these charts, that will be reflected in the data and captured by the model. We just looked at the World Consumer Goods Index. Performance walking forward in the S&P 500, very favorable. Red, 1 month out. Yellow, 3 months out. Realistic expectations. The below, below, and above, aboves aligns perfectly with the secular trend thesis. The S&P 500 broke out, started the secular trend in 2013. These are counter trend moves and then a resumption of the bullish trend moves here. Not the case here or here. Anything else? This is the Dow Jones World Consumer Goods Index. Yes, Dow Jones European Industrials Index. Familiar look. A look that we want to embrace. Something that just happened in 2019. And this table's nice. It reminds us that no signal of any kind is perfect. But even this entire table aligns with our good things happening 2 to 3 years out theory. And remember, we're using these as confirmation signals. We wouldn't even be looking at the Dow Jones European Industrials Index until we have bullish crosses on all of the major indices in the U.S. We'll look at this date here. Bullish cross on 5/31/2002. 5/31/2002, we do not have a bullish cross on the Dow. That cross doesn't come until June 30th, 2003, which means this portion of the table we really wouldn't even be using as a confirmation signal because there's no signal in the U.S. to confirm here. This is the Dow Jones European Industrials. Anything else? Yes, Taiwan. Calendar year 2019. This is the type of look that we want to embrace. Doesn't look anything like, not even remotely close to the type of look that we want to avoid. Walking forward historically from a look like this, really good things happened in the S&P 500. 100% of the cases positive 3 months, 6 months, 1 year, 2 years, 3 years, 4 years, and 5 years. Simply telling us to keep an open mind about better than expected outcomes. And the look of this table aligns with and in no way contradicts the theory that we could be in the early stages of a long-term secular trend, If we're in the early stages of a long-term secular trend, that aligns with every single table that we've covered in this week's video. This is exactly what a long-term secular trend would look like. Taiwan, anything else? Yes, Dow Jones Global Index. This is the type of look that we want to embrace. We can see this, measure it, put it in a model, walking forward historically, using all of the data that we have. 100% of the cases, the S&P 500 was higher 1 year later and 2 years later. This helps with realistic expectations. This green here aligns with the secular trend theory. The secular trend is over here and resumes here. The look of this table here aligns perfectly with this theory here. If this is true and this looks like this, and regular viewers know the demographics back that up as well, and you're well versed on how to use MACD, then this aligns with all of that perfectly. This is exactly what we would expect to see. Secular trend, consolidation, resumption of a secular trend. Last week we said wouldn't be unreasonable for the S&P 500 to be 30% higher in 2 years. The Dow Jones Global Index and this cross aligns with that hypothesis. Not predicting anything here. As long as the data aligns with the hypothesis and thesis, then we walk forward under those assumptions. If the data starts to contradict it in a meaningful way, then we adjust the hypothesis and eventually the thesis. Dow Jones Global Index. Anything else? Yes, Dow Jones European Nordic Index. This is the type of look that we want to embrace. This is calendar year 2019. And this is what happened in the S&P 500 historically when we walked forward from similar looks to what just happened in calendar year 2019. 2 years later, average S&P 500 return, almost 30%. Our normal minimum investment for one account is $600,000. As of the release of this weekend's video, we are lowering the one account minimum for a very limited period of time. Between December 6th of this year and December 16th, this $600,000 minimum investment will drop to $400,000. There is no change for 2 accounts and no change relative to the minimum for 3 accounts. This data comes from the Investment Company Institute. The average annual expense ratio for a growth mutual fund is 0.77%. The average annual expense ratio for a sector mutual fund is 0.78%. Thus, for comparison purposes, we can use a number right in the middle, 0.775%. How does this average annual expense ratio compare to the average annual expense ratio for the current CCM model portfolio? Our current allocation based on the ETFs that we hold today and the percentage weightings is 0.0864%, which is almost 9 times cheaper than a typical growth or sector mutual fund portfolio. Thus, if an investor moved from a mutual fund growth portfolio with an expense ratio of 0.775 to the current CCM allocation with a significantly cheaper expense ratio of 0.0864, they would hypothetically save 0.6886% in third-party investment fees each year. As clients know, our fees are variable. They depend on our allocation. Currently, our fees are on the very high end of our typical range because we are heavily weighted to stocks based on the market's current risk-reward profile. When we hold more bonds and cash, our fees drop. Our current annual fee based on our current allocation, again on the very high end of the spectrum, is 0.977%. Therefore, if you offset this fee with the potential savings of 0.6886, you can make an argument that you would essentially get to have us manage your portfolio for 0.2884% a year. Earlier, we made the case that the Ned Davis warning on a blow-off top is useful. This is also useful and aligns with everything that we just covered. The blue line is global stocks. The red line, and this is a Ned Davis chart, it's the percentage of the global markets in this index with a rising 200-day moving average. This is where we are in the present day. It's exactly where we were in 2016 after a long period of consolidation and right as we were breaking out. Sound familiar? It should. Indicator in the exact same place it is today, following a long period of consolidation and a breakout. This is delivering the same confirmation message that we just delivered via these indices and these tables. This doesn't predict anything. We can simply use it as a monitoring and adjusting tool. We've shown in this week's video and in past weeks, because we've covered 1974 numerous times recently, from numerous perspectives, that the present day doesn't look anything like 1974, 1987, 2000, 2007, or even October of 2018. Here is another source that's basically saying the exact same thing. Bank of America Merrill Lynch. This is basically a bear market checklist. 1974, you're checking almost all the boxes. 1987, you're checking almost all the boxes. 2000, you're checking almost all the boxes. 2007, almost all of the boxes. That looks quite a bit different than today. We're basically in neutral territory today. In fact, the reading today is very, very similar to the reading around 1988 and very, very similar to the reading around 1995. Very similar to the reading around 1995. Very similar to the look of this chart in 1988 is the look of the present day chart. So these technicals look the same. In this broad look, this is basically the type of information that we cover every week. This is technicals, fundamentals, and sentiment. Totally different way of looking at it, but it says the present day looks similar to 1988, 1989-ish, and 1995-ish. It really doesn't look anything like these periods, and it really doesn't even look anything like October of 2018. So why do we look at all of this, and how can it be helpful? After these looks here, which is very similar to the present day, really good things happened in the stock market walking forward from these dates, which hypothetically is similar to walking forward from this date. This just happened 6 days ago, and it's very, very difficult to say it looks materially different from these periods. You might want to ask, how is your robo-advisor going to handle something like this? You could pay a lot of advisor fees by mitigating some of these losses. It's not a question of if something like this is going to happen again or if something like this is going to happen again. It's simply a question of when. One more question. What do the facts on the following slide say about bearish probabilities relative to bullish probabilities? Here's the present day look. Looks very, very similar to this green box, this green box, this green box, and this green box. And relative to bearish probabilities, the present day green box looks nothing like this red box. Not even remotely close to this red box. Looks nothing like this red box, nor this frightening look here. And historically, something that's happened recently in 2019 tells us that really, really good things could happen walking forward, which is quite a bit different than the gloom and doom theories that are all over the place in the present day. It'd be very, very difficult to say that any of the facts that we've presented in this week's video contradict the secular bull market thesis or the demographic thesis in any shape, form, or fashion. And we know the only way that any of this is useful going forward is if we keep a flexible, unbiased, and open mind. And if the market is to rally for 1 to 2 more years, we have to be open to, even within the context of a secular trend, another cyclical and painful pullback. Thus, every single thing that we've covered in the videos in the past few weeks, they help us with bullish probabilities, and eventually the same charts and the same signals help us monitor and assess bearish probabilities. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.